2 hours in understanding how to manage this risk, because this in itself is a very large and a complex market. So our objective will be to primarily understand how do I manage the risk. Okay, and Mr. Pushp, how do we take the question answers? We'll take it at the end of the session.
Yeah, at the end of the session we will take, unless something is very relevant, and it is good to take at the end of the session so that the flow is not disrupted.
Okay, great. So everyone, if you have any questions, please write it out on the chat box. And towards the end of the session, I will try and invest a decent amount of time in answering your questions. Okay, so please feel free to ask. It's an open forum. Please do not take it as a lecture. It is something that I want to share knowledge and wisdom, but at the same time, I also want to ensure that all of you understand what I'm trying to tell you. Okay, it is not. It might be slightly confusing in some places, but it is. Believe me, it's not very complex. It's plain and simple logic and common sense. Okay, so we are wanting to get awareness about the trends in forex risk management. Okay, so I will look at the agenda. This is the broad 6-7 points that I want to cover. The first and very critical agenda for all exporters and importers is about how to manage the forex rates. Okay, the rates are very volatile. Rates go up and down every time. How do I manage the rate? How do I ensure that the rates are transparent to me? How do I understand that what is the forex transaction that I'm trying to do? So I'll invest a decent amount of time in understanding about management of rates. Then in addition to management of rates, there is also understanding what are the risk management instruments that are available. Okay, all of us understand that the exchange rates are very volatile, and that gives rise to what we call as the forex risk. So how do I manage, or what is the instrument to available to manage the risk is what about we are going to discuss about the risk management instruments. And the third and a very critical aspect, ladies and gentlemen, is, I've been in this market for more than 21 years now, probably close to have interacted to about 7,000, 8,000 companies all over India. And all exporters tell me one simple thing. Okay, they tell me, Mr. Victor, dollar is always on an uptrend. Okay, dollar is always gaining. 3 years back, it was 68, 69. Now it is 75. And probably 3-4 years later, it will be 80, 85. So obviously, future, no one knows. But the dollar is always on an uptrend. So if dollar is on an uptrend, then why should exporters hedge? Exporters will always realize better, and importers will always pay more. Okay, so it's a kind of a misguided conclusion. I will prove with facts and figures, what is the reality? What is the actual reality in the markets? That is what we need to understand. For all importers, point number 4 is very important. How do I hedge long-term liabilities? If you have long-term imports, or if you have long-term liabilities, then how do I hedge those liabilities? Again, coming back to exports, very interesting. How do I optimize interest cost on my exports? There are ways and means of getting this cost very close to zero. So how do I do it? Then obviously we'll come and show the various challenges that are there in the forex markets. How does our mobile application, we have been working on a mobile application for the past 2.5-3 years, and it is live and real now. All of you can download the application. So how does this mobile application help in overcoming the forex challenges of the country is what we discuss on point number 6. And point number 7 is something that I have added. Typically, it was not there on the agenda, ladies and gentlemen. But wherever I go, whatever seminar, whatever webinar, whatever speech I gave, whatever association, whatever training, everyone asks me, Mr. Victor, where do you see the dollar going to? Is it going to 72 or is it going to 78? This is the common question that I get everywhere. So obviously, no one knows where the dollar is going to go because it's a massive market. It is future. But we'll try and make an intelligent guess. We'll try and make an intelligent estimate as to what are the probabilities and where is the currency likely to go. Okay, so let us start one by one. And I would very earnestly and openly request to all of you participants, please feel free to ask questions. We have a decent amount of time dedicated and allocated for answering as question answer session. So please feel free to ask. Okay, so let's come to the first aspect about how do I manage forex rates. Okay, see, whenever you're looking to manage rates, understand one very important thing, and that thing is, what is the kind of the transaction that we are trying to do? What is the forex transaction that I'm trying to do? All exporters and importers does various kinds of forex transaction. Then what is the transaction that I'm trying to do? Why is this important? This is important because all the rates calculation, all the forex rate calculation will depend upon your transaction type. Okay, let me explain more clearly. See, the forex rates are quoted, there's something called the spot rate. Okay, forex, what we see on the terminal on the screen is something called the spot rate. Now the question is, I want to do a transaction where the debit or the credit is going to happen today. Okay, let's take I am an exporter and I have received $1 million and I need to convert that and get the credit today. So will spot rate be applied? Okay, now that is what you need to understand. Actually, the spot rate is not for settlement today. Okay, spot rate is a transaction, which means that the settlement will happen 2 working days later. Okay, now the question is, if spot is for a settlement 2 working days later, then what is the rate that I should get for today if I need to convert my cash today? So for today, what you get is something called the cash rate. And the cash rate is derived from the spot rate. So spot rate minus a component called the cash spot is something that leads to getting the cash rate. So understand, all of you, all exporters and importers, that whenever you are doing a conversion which is settled today, settled mean the debit and credit in the bank account. So typically when you are doing a forex transaction, if it is an import payment, then the debit will happen today. And if it is an export receivable, then the credit will happen today. So those credit today means it is a cash transaction. And cash transaction means the computation is spot rate minus the cash spot. Okay, so cash is for today and spot is for T+2, which means today plus 2 working days. So the question is, then what is it for tomorrow? Because there is 1 day in between, right? That is tomorrow. If tomorrow is working, then what is for tomorrow? Tomorrow is what we call as TOM. And TOM is simple spot rate minus cash TOM. Just like you had cash spot, you have cash TOM here. Okay. In the next slide, I will give you a table which will very clearly highlight and communicate this, and all your questions will be clarified. But let me just finish what forward is. See, forward is for any settlement which is beyond the spot date. For example, let's take you are an importer and you have a $500,000 payment after, let's take 3 months. And the currency you feel now is at 73, and it is a very good level to buy dollars. Okay, so what you do is you can hedge using a forward for a payment 3 months later. So the rate that you will get is spot rate, which is 73, plus the premium for 3 months. Okay, so your settlement is 3 months later. That is what is called as a forward rate or a forward contract. If you just look at this table, this will very clearly highlight what are the transaction types. You have cash, TOM, and spot, and forward as well. And what is the computation or what is the calculation methodology? Okay, so as I said, for cash, you have spot rate. Again, let me repeat, spot rate is something that will be used for all transactions. That is the benchmark of all forex rates. Spot rate is the benchmark or starting point for all forex rates. So even if I want a cash rate, it will be spot rate minus cash spot plus something called a bank margin. For importers, it will be added, and for exporters, it will be subtracted. Now, what is a bank margin? A bank margin is the compensation or the fee that you pay to the bank for the conversion. So understand that it is a cost to you. Since you are paying a fee or you are paying a compensation, understand that it is a cost to you. So the interest of each and every exporter is to ensure that the bank margin is the least and it is the lowest. Okay. So bank margin will be something which will be a universal factor, and the spot rate will be a universal factor. So depending upon the kind of transactions that you do, either if you do a cash transaction, the cash pot will be subtracted. If you do a spot transaction, then nothing will be subtracted and added. It will be directly your bank margin. And if you want to do a forward transaction, then obviously the concept of forward premium will come into picture. Okay, so in the first step in managing rates is understanding the transaction type. Understand what is your inherent forex transaction. Do I want a debit or a credit today itself, settlement today itself? Do I want a settlement in the future? Do I want settlement tomorrow? Do I want a settlement on spot date? So depending upon your transaction type, your rates calculation will follow. Okay, the rates calculation will follow. And this is very important to understand, because the rates is something that directly hits your top line and bottom line. Okay, if it is a foreign currency, it is ultimately going to be converted using the exchange rate. So understanding the components of the exchange rate is very, very critical for your business. Okay. So let's go ahead. Again, any questions, please write it out now itself. You want to write now, you want to write later. I'll take everything one by one. Please feel free to type it out. You know, this is a very common question that I hear from a lot of exporters and importers in India. I always feel that the banks overcharge while converting foreign exchange, which means that the bank margin is not transparent and the bank margin is not something which is clearly communicated. So that is the reason why most of the exporters and importers feel that the banks are not, passing on their real rates to the customers. Okay. Now, this unfortunately is a big problem for a country like India, where there is a huge lack of transparency, and the spot rates and the live premium rates are not available in public platforms. You might Google search for whatever is the exchange rate, but take it from me, ladies and gentlemen, these exchange rates are not real time. These exchange rates are delayed. And if an exchange rate is delayed and not real time, then obviously you do not get the right price. Okay, so unfortunate for India, there is a huge lack of transparency about forex rates in India. One very critical aspect, you have become smarter after this webinar. So understand the concept of bank margin. Bank margin is a cost that you are paying. Unfortunately, in India, it is deliberately kept variable and unclear, but you have to ensure that this bank margin is clear and transparently communicated to you. You have to ensure that this is fixed and not kept variable. Okay. Again, banks usually quote a net rate while executing transactions. I'm sure all of you have seen this, experienced this. Whenever there is a conversion, you just get a net rate. Okay. Whether it is $5 lakh to be sold or $1 million to be bought, you just get a net rate for your conversion. You don't know how the rate is calculated. What are the various components of the rates? How much the bank margin is calculated or charged to you? What you need to ensure is that each and every variable, the spot rate, the cash spot, everything is clear and transparent to you. Okay. Now, another very big factor or unfortunate for India is that the exchange rate is volatile, but you are not able to take the advantage of it, because obviously you have multiple tasks to do. You have a lot of work to be done. Your shipments, your orders, your packaging, your finishing of the products, you're buying the raw materials, so many things you have to do. So, but the time when you're doing it, the markets are moving volatile. The markets are very volatile. Any day, the exchange rate moves anything between 30 to 40 paisa per day. Every day, there is a large movement in the exchange rate. And I am unable to take the benefit of it because I have many other tasks to do. Okay. One way of doing it is you can hire a professional. Okay. The other way is, understand how to do it, understand how to capture the rates. And that knowledge, any professional can give you very easily and very freely. One more thing you need to understand, all of you, is that the banks are our counterparty. Remember, whenever you're doing an export-import transaction, your banks are your counterparty. Everything is getting converted at the bank. And remember, the banks are a corporate, they are a commercial establishment, they want to maximize their profit. So if their profit is maximized, understand the cost is on you. So you have to ensure that all these costs are minimal and optimum and not overcharged. I spoke about cash pot in the previous slide, and I said that cash pot will be subtracted, it will be reduced. So what does that mean? That means that if the rate is, let's take 75, and the cash pot is, let's take 2 paisa or 3 paisa, then for the rate for importer is, cash rate is 74.97, 75.00 minus 3 paisa, which is 74.97. So the rate is reduced. The rate is reduced for an importer. So that is a benefit to you. Understand, cash pot is a benefit to you. But unfortunately, what happens in India is the level of awareness is very poor. People do not know what is cash pot. So that benefit, which is accrued or to be passed on to importers, because of lack of awareness to importers, this rate is not given. That benefit is not given. The bank pockets that benefit. So be very clear, all importer clients understand cash pot and understand that it is a benefit to you. You should get that benefit. And since it's a benefit to importers, it is a charge to exporters. Okay. And in India, it is always charged to exporters. So all exporters know about cash pot. Very few importers know about cash pot. This is again a small piece of wisdom that I wanted to share with all of you in terms of the rates management part, because understand the rates is what hits you. That is what gets debited or credited in your bank account. So it has a direct impact on your profitability. And since it is something very critical and has a direct impact on your profitability, it makes sense that you invest some time in understanding the mathematics and mechanics of it. Okay, so let's move on. Very important. What are the risk management instruments available? All of us understand that there is a risk. The currency is very volatile. It goes up and down, and no one knows how much it goes up, how much it comes down. Future is very uncertain. So how do I manage the risk? How do I ensure that I am not facing undue risk? I'll tell you what are the instruments that you can use to mitigate the risk. Broadly, there are 3 categories of instruments. The first category is forwards and futures, which is the most simplest form of a risk management instrument. It is an agreement to buy or sell a currency with another currency at a specified future date and at an agreed rate today. So in term, simply put, what are you doing? You are just fixing the rate for a future date today. You're fixing the rate today for a future delivery. Okay. So it can be for imports, it can be for exports. Forwards are done with banks and futures are done at exchanges. Forwards and futures are very similar instruments, but they do have some specific differences. The differences are outlined here. Forwards are with banks, futures are with exchanges. Forwards are customized contracts. Customized in the sense you can have for $1,50,354. But if you go to a future, there will be lots. So you will have to trade in lots of $1,000. So that means that it is standardized. It's not customized. Forwards can be used for receivables and payables, But on the futures, you have to say, cash settle your positions. You cannot deliver documents there. Documents have to be delivered with your bank. One very big advantage with futures is that the rates are very clear and transparent. In forwards, the rates are opaque because that is a still open system. The rates have not become very transparent, what I was addressing in the previous few slides. But in futures, the prices are very transparent, crisp and clear. You can see it online. Forwards, the transaction costs are high. As I said, the bank margins are very opaque. In futures, the transaction costs are fixed. Okay, so there is no opaqueness about transaction costs in futures. So as I said, the most simple form of an instrument is a forward, where you can just fix your rate for a future delivery. So once the rate is fixed, you are not exposed to any risk. Wherever the market goes, you know that your dollars will be converted at that rate. It's a very simple instrument, and it is very widely done in the market. It's one of the most commonly used risk management instrument. The other type of instrument, which is a slightly more advanced version, is what we call as a currency option. Currency option is very different from a forward. What happens is, in forward, the rate is fixed and it is an obligatory contract. You have to honor that contract. Okay, so it is an obligation. But an option gives you a right and not an obligation. Okay, so in one way, it protects the rate, but at the same time, it gives you a choice. It gives you an option. It gives you a freedom. It gives you a right. Okay, and since it is a right that is given to you, you decide that on maturity whether I want to exercise that right or whether I don't want to exercise that right. So understand, it is a right and not an obligation. And to get that right, you have to pay a premium, what is called as an option premium. So understand, forwards are free. You do not have any cost. The only cost that you pay is a bank margin. But in case of a currency option, you have a right, you have a flexibility. And because of that right and flexibility, you pay an option premium. So option is not free, it comes at a cost. Vanilla options come at a cost. There are structured options, ways and means where you can reduce the cost and also get the cost to zero. Okay, but those are, structured complex options. So they are complex structures. Anyone who wants guidance or understanding on options, please feel free to reach out to us. I will share my email ID and mobile number also. This is a very good risk management instrument. It freezes one rate, but at the same time, it gives you a flexibility. So your worst case rate is protected and your best case rate is completely on the market. So there are two kinds of options: the right to buy a currency, which will be used by importers, and the right to sell the currency, which will be used by exporters. So right to buy is called a call option. Right to sell is called the put option. Now, there are other types of options as well, American and European. But for the convenience of everyone here, understand that in India, only European options are used, which means they can be used only on maturity. American options are options that can be used on any day from the trade date till maturity. Okay, but that's a very complex structure, not allowed in India. So for us, only American options are allowed, and you can use calls, you can use puts depending upon your exchange rate risk. And as I said, anyone who wants exposure in terms of understanding, please feel free to reach out to us. A third category of a risk management instrument is what we call as a swap. And there are two types of swaps: currency swaps and interest rate swaps. Currency swap is used to manage currency risk. Interest rate swap is used to manage interest rate as well as currency risk. So it is typically an agreement between two parties to exchange a sequence of future cash flows. Okay, so a sequence of future cash flows are there in the future. So you can fix the rate today itself. So I'll give you a very simple example. Let's say you have a long-term loan, okay, and in that long-term foreign currency loan, let's say you have taken $50 million of loan and that loan has to be repaid after 1 year on equal installments of 6 months each. Okay, so you have an exchange rate risk because you have to pay amortization of the principal every 6 months after 1 year. So that can be swapped, currency swap. You can swap it with your bank. Okay, and at the same time, since it's a loan and the loan is linked to the LIBOR or currently the short-term funding rate, so the short-term funding rate can also be fixed. So you will move from a floating interest rate to a fixed interest rate. Okay, so you can hedge your interest rate risk and you can hedge your currency risk also. You can move from floating interest rates to fixed interest rates. If you feel that the interest rates in future are going to go up. Obviously, you can do the reverse as well. If you feel that the interest rates are going to go down, so you can move from fixed to floating. So these are all what we call as swaps, interest rate swaps and currency swaps. Interest rate swaps helps in freezing or hedging your interest rate risk, and a currency swap helps in freezing or mitigating your currency risk. Okay. Anyways, I will share this presentation with all of you, each and every one of you. You can read through it, understand it. If you have any queries, you can reach out to us. These are not simple things. These are relatively complex things, but if you invest your mind and time on it, it can be very easily understood. Okay. Now, very interesting what I was saying in the beginning when I discussed the agenda. All the exporters tell me, Mr. Victor, the dollar is always on an uptrend. Exporters don't have risk. Importers have risk. So the importers need to hedge. The exporters need not hedge. So it's a very misguided conclusion. And I am going to explain facts and figures as to what is the reality. Now the questions we ask is, does the rupee weaken always? Does the rupee always go higher? Dollar always go higher, which means rupee, does it weaken always? That is not true. Rupee does not weaken always. There are times that rupee gains also. So what happens during that gaining time? What about the dollar INR forward premiums? Forward premium means whenever you are hedging for the future maturity for a date later than spot, you get a premium. So you have to look at the premium aspect as well. The question is, are we looking at the complete picture? Now, what we did was, we did a very simple analysis. A very simple analysis to, prove that dollar is always gaining and exporters need not hedge. This is not true. Exporters certainly needs to hedge. I will tell you how, and I will prove you that this is all historical facts. And again, ladies and gentlemen, understand these are all facts. Okay, what I'm going to tell you in the next 3-4 slides are all facts. This is not a view. Okay, this is not a view. View I will discuss towards the end of the presentation. These are all facts. Okay, so this is research on actual factual data. So if you want to test it or if you want to audit it using some other professional, you can do it and the result will be the same. Okay, so let me tell you what we actually did. We did a very simple exercise. Very, very simple exercise. From the 1st of Jan 2000 onwards till the end of Jan 2022, that is just 1 week back, every working day, we took a forward. Actually, we took 3 forwards. We took 1 forward for 3 months, we took 1 forward for 6 months, and we took 1 forward for 12 months. Okay, so understand, every working day, we took 3 forwards. 1 for 3 months, 1 for 6 months, 1 for 12 months. And on the end of 3 months, on that maturity, we check the forward rate compared to the spot on that date. Okay, so forward rate is what you get if you do a forward. If you don't do anything, you will get the spot on that rate. Okay, spot rate on that date. I just do a simple comparison of this forward rate with the spot at that date. So if the forward is more, then the exporter gains. If the forward rate is less, then the exporter loses. Okay. So last 22 years or 21 years, I see how has these forward rates and the spot at maturity behaved with each other. Now understand one thing very simply. When I am getting forward rate, what does that mean? I am getting the forward premium. Okay. So I am getting the forward premium. Forward rate is spot rate plus forward premium. Forward rate is spot rate plus forward premium. So it is plus. So I need to see what is this forward premium percentage, and what happens when I don't do anything. When I don't do anything, it is the natural rupee depreciation. So actually, it is a simple comparison between the spot at maturity, which is rupee depreciation, and the forward rate, which is the forward premium. Okay, so the next slide has the results. Ladies and gentlemen, the results are exciting, very startling, and it will dispel all myths. Okay, let us understand the result one by one. For 3 months, the average annualized forward premium is 4.43%, which means if I do a forward, I will receive 4.43%. The average rupee weakening is only 2.7% or 2.69%. Average rupee weakening is only 2.69%. Average forward premium that I get is 4.43%, which means if you are blindly doing forwards for 3 months continuously every day for the last 22 years, you get a free profit of 1.74% per annum. Again, ladies and gentlemen, listen very carefully. It is a free profit. Free profit meaning every time if you keep selling forward contracts, you keep receiving forward premiums, you get 4.43%. If you do 6 months, you get 4.25%. And if you get 12 months, you get exactly 4%. The currency weakening is only 2.7%. So 12 months will gain 1.3% per annum. 6 months will gain 1.56% per annum. And 3 months will gain 1.74% per annum. So this is free gain that is available if you blindly do forward contracts. And if you see the success ratio, obviously the number of trades will be very high because you are doing every day. So they are like 220, 230 days every year, and you're doing for 21, 22 years. So it will be 5,300 days. Okay, so the number of days or number of trades are very high. Now, successful trade means the forward rate is more than the spot at maturity. So it is the success rate is as high as 65, 66%. So the conclusion is that if you do forwards on a regular basis, you will, on a long-term basis, you will end up making money. And you will end up making handsome money. 1.3%, 1.7% is no joke. And that too, without applying too much of your mind. It is just doing a simple forward every time you get your order. Okay, take this conclusion, think over it. It is going to make a lot of difference to your bottom line if you are an exporter. As of now, you are not hedging, and you can use this idea to start hedging. Okay. So let's move on to the next. One small idea I want to give you. Again, this will save you a good amount of money. Whenever you're doing a forward, you can do a forward in 2 ways. Either you can keep a fixed date maturity, where your maturity is one particular date, or you can use a window forward. Window forward means that your maturity is a period, time period. It is not one day, it is a time period. And as per current RBI regulations, the maximum time period is 30 days. Obviously, minimum is 2 days, because if you do 1 day, it will become a fixed day maturity. So from 2 days window period to 30 days, it is called a window forward. And this is customizable. You can do from 1st to 30th, you can do from 1st till 15th, you can do from 18th to one month to 17th of next month. So the maximum is 30 days, minimum is 2 days, and it is customizable whichever way you want to do it, whichever period you want to select. But max cannot extend 30 days. Understand that. Now, what is the problem? What we suggest to all exporters and importers is do fixed date forward and don't do window forwards. Now, why am I telling you? Now, that is the logic I'm trying to give. See, if you do a window forward and you're an exporter, you receive premium only till the first day. You receive premium only till the first day. Okay, so if you have done a 30-day window, you get premium only till first day. And remember, you are receiving premium. So if you would have done a fixed day forward, then you would get the premium till the last day or till that day. Okay, so in a window forward, it is a loss. In the beginning, on the day one itself, your rate is getting reduced because you are receiving less premium. But if you do a fixed day forward, you receive premium till that day. And if your money comes before, then you can always early utilize the forward. You have to just pay back the balance premium. The same happens for importers. Importers also, if you do a window period, your premium is charged till the last day. So you have already paid a higher premium. Your premium will be charged till the last day. So best case for an importer is decide on the maturity, take a contract till that working day. Okay, take a contract till that day. If your payment happens earlier than the maturity, you can early utilize it. And for an importer, you will get the excess premium back to you. You can claim back the excess premium. So for all exporters and importers, doing fixed day forward makes more sense than window forward. Okay, then, for argument's sake, the question is, if window forward is so useless, then why was it there in the first place? A lot of people ask me. Actually, ladies and gentlemen, window forward was there long time back, and they were very commonly used when the forward premiums were very less. Now the forward premiums are high. Forward premiums are as high as 4.5% per annum, which is effectively like about 22 to 25 paisa per month. So if it is 25 paisa per month and you do a 1 month window, you have straight away lost 25 paisa. Window was done long time back when the annual premium was 60-70 paisa, which means for per month premium was only 4-5 paisa. So that time, if you would have done window forward when forward premiums are low, you would have lost only 4-5 paisa. But now you're losing 25-28 paisa. But people, since they have been using 15-20 years back, they continue using the same thing without applying the mind that now window forward is expensive and there is no point doing it because the loss of premium is very high. So the conclusion is, if the forward premiums are low, it is just like 4-5 paisa per month, then you can do a window forward. But if the forward premiums are high, the way it is high now, you should do a fixed date forward. Okay, again, just to remind, any questions, please put it in the chat box. I will answer one by one. Okay, now this is another query that comes to me very regularly. Mr. Victor, I have long-term liabilities. How do I hedge my long-term liabilities and what are the industry best practices? So please give us wisdom and guidance in terms of managing long-term liabilities. Okay. Now, just before we just get into this, understand what I said in the previous slide. Okay. The average forward premium is about 4.5%, which means if I do long-term hedge here, I have a 4.5% hedge cost per annum. What does that mean? That if I have a liability to be paid after 2 years or after 18 months, then I will have a premium of 4.5% per annum, which means it will effectively be more than 9% to the current spot. So in terms of rupee, if dollar INR is 75, then 9% is around 7 rupees. So your forward rate will be 81, 82. Okay. So for an importer or a company with long-term liabilities, taking a hedge decision is very difficult because the premium cost is very, very high. Okay. So what are the industry practices, or how does big treasuries or big companies do it? I want to share that wisdom and knowledge. Again, how do I know how did they do it? Is I was myself the chief treasurer of a very large exporter. So again, being an industry veteran, so I have the idea. So I can share that idea with you. See, there is a concept called first day forward rate. Now, what is a first day forward rate? Just go by the meaning. First day forward rate, which means that, let's say I have a long-term liability that I know today. Today is day one, and I have a liability to be paid after 18 months or after 24 months or after 36 months. I know today the project or anything, the import or the loan or the project is concluded today. So I know that the liability is there. And as long as the liability is there, I know that the risk is there. So how do I manage that risk? You can apply a first day forward methodology. And what does that mean? That means that what happens if I hedge that liability today itself? That means that if the liability has started today, okay, the exposure has started today, and I have to pay after 18 months or after 24 months. I need to take a decision. Should I manage or should I hedge that risk? There is no point in hedging the risk today, but you can apply a methodology of first day forward rate, which means that if I were to hedge today, okay, if I were to hedge today, then what is the, sorry, if I were to hedge today, then what is the rate that I get? Which means I have hedged my liability on the first day itself. Okay, I have hedged the liability on the first day itself. So if I do it, what is the rate I get? Let's take the rate is 82. First day forward tells you that you benchmark 82, don't hedge. Just benchmark 82, don't hedge. Let the market move. Let 3-4 months elapse. If 3-4 months have elapsed, then for 3-4 months forward premium is reduced because your maturity is now lower than by that many months. Earlier 4 months ahead it was 24 months. 4 months have passed. Now the balance month is only 20. So it's only 20 months premium. So premium will reduce if you don't do anything and you just let time lapse. And probably in those 4 months, the spot might have come down. The spot might have gone up also. It might have come down as well. That risk is there. But 2 years is a very long time. You get both situations, dollar going down and dollar going up, a big cycle in 3-4 months itself. So if the spot has come down and the premium has elapsed, and now the rate is about 2% or 3% lower than the first day forward rate, then you can start hedging. Because if you hedge now, the hedge cost is already reduced by 3-4% or 2-3% compared to the first day forward rate. So if I were to hedge on the first day itself, I would have got first day forward rate. But now when I'm hedging, I am getting the rate which is 3% lower than the first day forward rate. So might as well hedge now. Let me eliminate currency risk because I'm already in the money and I'm already making money. Now, this methodology, if you watch closely, goes from the previous slides where I explained that the average annual premiums are 4%, but the average rupee weakening is only 2.7%. Okay, so forward premiums are more than the risk, and that is a deterrent to long-term hedge. Now, what we recommend companies who have long-term hedge is very simple, that don't hedge very long-term because the premium cost is very high. The risk of rupee weakening is relatively low. So whenever your repayment schedule becomes less than 1 year, then you can look at hedging. And the basic risk, conclusion is also that, dollar INR experiences two-way volatility. There is always two-way volatility. Understand, in the long term, it might have gone higher, but in between, rupee gains, dollar gains, rupee weakens, dollar weakens, both happens. So because there are two-way volatility, all the importers or all the payers of long-term foreign currency debt will have ample opportunities to hedge. Okay, less than 1 year also, hedging for less than 1 year also entails that my forward premiums are lower compared to earlier times. If I hedge for 2 years, if I hedge for 3 years, then forward premiums are very large. Now, understand one more thing, why we tell companies not to hedge long term is that even though forward markets are active till 5 years, the forward markets are there till 5 years, but the real trading and the real volatility and the real liquidity is only there till the next 1 year. Okay, which means the real trade, real liquidity is only there till the next 1 year, which means that if you go beyond 1 year, the rates will be very wavered. And if the rates are wavered, it will be always against you. It will never be in favor of you. It will be in favor of the bank. Okay, so this is another argument which is in favor of the fact that you should look at hedging for periods less than 1 year rather than periods more than 1 year. You can apply the first day forward methodology. It is a industry-wide used practice. A lot of large importers use it. A lot of large companies who have long-term foreign debt, they use it because they understand the conclusion that the forward premiums are high, the hedge cost is high, but the actual currency weakening are relatively lower. And since there are two-way volatility, you will always get opportunities to hedge. Okay, keep this in mind, all importers or all exporters who have long-term hedge. Now, this is also a very interesting subject, a very interesting concept. How do I optimize interest cost on exports? Okay, what are the tools available, and how do I ensure that the interest cost that I pay is the least? So all exporters, I'm sure all of you understand what is packing credit. Packing credit is export credit or credit for export funding, working capital funding for exports. So if you have an export order, you can approach your bank, and using that export order, you can ask them to lend you packing credit. Why packing credit? Because since it's a loan, it's a credit, the interest rates are lower, and it is export credit. So the interest rates are lower than CC. The interest rates are lower than other forms of funding. Now, packing credit can be taken in two ways. Okay, you can either take it in direct foreign currency way, or you can take it in INR. Now, there was a government scheme of interest subvention to take packing credit in INR, and that subvention was 5% for MSMEs and 3% for non-MSMEs eligible exporters. Okay, so 5 and 3 was there. Unfortunately, till 30th September 2021, it was there. It is not continued, but there is a lot of talks and discussion that the interest subvention on packing credit in INR will come back. Probably it might come back in a different form or way, but ultimately it will come back. The government has already provided an increased allocation for this in the current budget. So it will come. The finance ministry has already approved it. It's only pending at the commerce ministry side, and it is going to come very soon. Okay, so how does that affect me as an exporter who wants export funding? So I need to look at it. In this slide, I have just assumed that I am before 30th September, so subvention was there. I will also take the next slide, which will outline that if subvention is not there, then what should I do? Okay, but first, let me tell you, if subvention is there, what you should do. See, PCFC interest cost will be SOFR or short-term funding rate or LIBOR, what is written here, LIBOR plus the spread. And the spread nowadays is anything between 2 to 2.5%. So your total cost is around 2.2 to 2.7% for PCFC. Okay, this is very clear, very simple. But let's take you take a packing credit in INR. Let's take you are an MSME who was eligible for 5% subvention. And MSME PCINR rate was anything between 7 to 8%. So 7-8% minus 5% is what your rate was. Okay. But ladies and gentlemen, there is one very important added element which is missing. And what is that? See, when you take a packing credit in INR, you take that INR today, but you are going to repay after 3 months, 6 months, 12 months, or 9 months, or let's take 4 months, whatever period, your packing credit period. You're going to repay that packing credit in the future, and you're going to repay using the foreign currency inward that you get. So for conversion of that foreign currency for that future maturity, I can take a forward. And if I take a forward, I get 4.5% forward premium. So understand very well, I get 4.5% forward premium. My effective rate, because of this forward premium, is 0 or negative. Okay, 5% interest subvention I got, 4.5% forward premium I got. My interest cost was 7-8%. I have received 9.5%. So my interest cost is negative. Similar is the case for non-MSME exporters who are getting, but their interest cost was slightly lower. So 3% minus is subvention, 4.5% is the forward premium. So 8.5%. So here also your interest cost is negative. So understand very well, if the subvention is there, then availing that benefit of subvention in PCINR, packing credit in INR, and taking a forward rate makes your interest cost 0. Now, how does it work? It simply put, what you do is you take the packing credit in INR. Let's take you take 10 crores in INR, and your packing credit PC period is 90 days or 120 days or 150 days. You have to repay back after 90, 120, 150. That 10 crore you convert at the current exchange rate, you get $1.33 million. What that $1.33 million, you can take a forward rate, a simple forward, because you will repay this packing credit in INR using your foreign currency inward. And for that conversion of that foreign currency, you can take a forward rate. You can benefit the premium of 4.5%. And when that foreign currency inward comes in, you can use that forward contract, convert it using the forward contract, and repay the packing credit. So your interest cost, effective interest cost, sorry, getting the benefit of subvention and also getting the forward premium becomes 0. Your interest is 0 or negative. Very interesting, very important to each and every one of you who are exporters and who take export packing credit. Now the question is, Victor, now there is no subvention. So what do I do? Now, even if I eliminate the subvention factor, okay, for a MSME who gets 7-8% and forward premium is 4.5%, my cost is 2.5 to 3.5% compared to PCFC, which is 2.2 to 2.7. But non-MSMEs who have interest rates or packing credit rates of 6 to 7%, if you reduce the forward premium, your interest cost is 1.5 to 2.5%. So if your net interest cost is 1.5%, it is still cheaper than your PCFC, which is at 2.5%. Okay, so what is the thumb rule? The thumb rule is, if the interest subvention is there, then simply take packing credit in INR, take the forward, get the benefit of forward premium and the subvention benefit. Your interest cost is 0 or negative. Okay, now if the interest subvention is not there, then what you do is you evaluate PCFC, all the cost elements of PCFC, evaluate all the cost, subvention and the forward premium of your PCINR. Whichever is lower, I will take that. So it's a, understand one thing, since it is a loan, my sole objective is to reduce the interest cost as much as possible. So whether it is subvention or whether it is no subvention, every time you take a packing credit, evaluate the cost elements, understand the net cost for you. If PCFC is cheaper, take PCFC. If PCINR is cheaper, take PCINR. But include the adjustment of forward premium. And if you're taking PCINR, and do the forward hedge, get the benefit of forward premium if you're taking PCINR and doing a hedging. That 4.5% is there for you to avail. Understand one more thing, if there are euro exporters, the forward premiums are higher. The forward premiums are 5.5%. So if there are euro exporters who are taking packing credit in foreign currency, they must switch to packing credit in INR. Because if your interest rate is 6% and you're getting 5.5% as forward premium, your interest cost is only 0.5% compared to 2.2 or 2.5% in PCFC. So next time you take a packing credit facility, please identify your cost elements and understand packing credit is in INR is cheaper or packing credit in foreign currency is cheaper. Okay, good. There are a whole lot of Mr. Pulch, should I address the questions now or should I keep on going? Mr. Pulch, you are on mute, I think.
Yeah, sorry.
No worries, no worries. Should I keep on going or there are already some 14, 15 questions?
So yeah, meanwhile, you can take 14, 15 questions. Somebody who has some other work and will get his question addressed.
Okay, great. So what I'll do is, I have completed a lot of it. So I will take questions now. And after I complete all the questions, I will take the remaining 2 points. Okay?
Yeah, it's fine.
Okay, great. Thank you. So let me, there are a few questions on LC. Okay, that I think is already addressed by the previous speaker.
Yeah.
Okay, so I will take the questions on forex.
Yeah.
Please mail PPT to us. Please mail. Okay, a lot of questions in terms of mailing the PPT.
Yeah.
Okay, that I will do. Okay, I am just trying to see if I have missed anything.
You can take the question, while entering into forward contract, does importer exporter have to pay receipt premium as a cost for fixed forex rate?
Okay, where is that question, sir? Yeah, I got it.
Yeah.
I got it now. While entering into a forward contract, does the importer exporter have to pay receipt premium as a cost for fixing the forex rate? Okay, have to pay receive. See, sir, forward premium is what you pay or receive as the hedge cost. Okay, forward premium will be around 25 paisa per month. Okay, 25, 26 paisa per month. So if you enter into a forward contract for, let's take 3 months, then your rate will be spot rate plus the premium for 3 months, which effectively will be around 90 paisa. So if the spot is 75, then 3-month forward rate will be 75.90. Okay, so you receive, or for exporter, you are receiving the premium. So 4.5% is added to your rate. So you are receiving the premium. And importer is paying the premium. So since it's a cost to you, now it was 75 and you are now paying 75.90. Okay, so it is, the premium is a cost to you as a cost for fixing the forex rate. So I hope you understood that the premium is the cost. Importer, the premium is the cost. For an exporter, premium is the benefit. So there is no other cost for fixing the rate. The only cost is your margin, which will be like 3, 4, 5 paisa per dollar. That is a very small cost.
Understood, sir. Understood.
Okay. Great.
So you can move on to the next question, sir. What happens if the contract of exports get cancelled and have forward contract?
Yes. Okay. This is a very good question. I'll explain with an example. I think understanding the example is easier. Let's take, you did a forward for, let's take 31st March. Okay. And your rate is, let's take 76 rupees. And it was an export forward for, let's take $5 lakh for 31st March at the rate of 76. Now, by 31st March, you have to deliver that $5 lakh. If you have not delivered, then on 31st March, you have to cancel it. Now, cancellation, there are two things. You can either do a cancellation or you can do a rollover. Now, what does rollover mean? Typically, what happens is, if you have done a forward of 5 lakhs, export forward of 5 lakhs, you will receive that 5 lakhs. The only worry could be that I have done a forward for 31st March. I have not received by 31st March. I might receive it in April or I might receive it in May. Okay. So if the export order is intact and only the maturity time of receipt has changed, then you should do a rollover. Rollover means cancelling the earlier contract and immediately rebooking a new contract for a new maturity. Let's take the receivable from March. Now you are going to get it in May. Then on 31st March, you can cancel the contract of March and immediately you can rebook a new contract for May. So you are effectively buying and selling the currency at the same time. So it's going to be neutral. Okay. So you can cancel the contract any point of time on the maturity or earlier than maturity. You can do a rollover also. If you are doing only cancellation, you will have a P&L impact. If you are doing a rollover, you will have a P&L impact now and you will have a new contract for a new maturity. Okay, so that is how cancellations work. Okay, but understand, cancellations or rollover both will have a P&L impact, profit and loss impact. Because 76 you have taken, if you cancel at 75, then obviously you will get 1 rupee benefit. But if you have taken at 76 and the market was 77, then you have 1 rupee loss.
Right, sir. Two small question. One, I think you have already explained. How does forex swap work?
There was 2 questions here while entering into this. I have answered.
What is the future of USD this month?
Okay, sir. Okay, so I will answer that question, sir. But again, future of USD, understand that no one knows. The market is like just too big, too large and vast. No one knows where the market is. But we'll try and make an estimate as to where the currency is likely to go. What I will do is I will explain it. I will explain it with reasons and logic in terms of where we are looking at the currency to go. Okay, but let me just invest 1 minute of time in just checking if I have taken all questions. Okay, just allow me 1 minute. I just want to see if I've taken all questions. I think there is one more question that has just come
Yeah.
on the bottom. Okay, I'll
Yes.
just.
If an exporter has entered into forward contract and the currency also depreciate in that period, he will get the benefit of both depreciation and the premium.
Okay, great. Let me explain. See, sir, if you have entered into a forward contract, okay, remember you have already received the 4.5% premium. That premium is fixed. The rate is fixed. The contract is fixed, and it is obligatory. So in that period, if the currency depreciates, okay, remember your rate is already booked. So if the currency depreciates or appreciates, that will make your contract in the money or out of the money, whether the contract is better or the rate is better. You can't get both the benefit. You will get one of the benefit, either the premium or the depreciation. Okay, so if you do a forward contract, understand you have already got the premium, you have received the premium, 4.5% or whatever is the premium at that point of time, you have already taken the benefit. If the currency depreciates only till that extent in that period, you are neutral. But if the currency depreciates more than the premium, then you will get a loss. Okay, so you can get the benefit of only one, you cannot get the benefit of both. Using an option, you can get the benefit of both, but option comes with a cost. Option is not free. Okay, I hope that satisfies this question.
Yeah, absolutely. So, so far we have taken almost all the questions, except that please email the PPT, which I will eventually do.
Okay, great. So I will complete my the other 2 points. Okay, and then probably we can.
Meanwhile, those who have any query, you can keep typing in the chat box or in the QA section, so that it is addressed by Mr. Victor on the spot only.
Sure. I will do it. Please keep typing your questions. I will take it as soon as I finish this. Okay.
Right, sir.
Now, this is a small, not small, a big effort that we have taken in the last 2.5 years. We have created a mobile application, and believe me, we have invested a lot of time, energy, effort, intelligence, actually a lot of intelligence on this application. And the basic objective and purpose of creating this app was to help and the exporters and importers and overcome their regular forex challenges. Okay, everyone understands that exporters and importers are facing challenges in terms of rates, facing challenges in terms of market news and insights, facing challenges in terms of alertness, how to capitalize on volatility, a lot of factors, but no one addressed it. Okay, no one addressed it. We came up with this application to address a lot of these challenges. Okay, and I will probably try and indicate to you what are the various features, and I will strongly recommend all of your exporters and importers to use this app. It is free of cost. It is there on Play Store. It is also there on App Store, and you can use it. It is free. It has a whole lot of facilities and features. I will explain one by one. Okay. Now, the real big challenge of India, as I was indicating, was the rates part. Okay. Here, we give you real-time rates. All exchange rates, real-time prices, directly fetched from the terminal. So what you get, delayed prices on the public platform, you will get real-time prices here. You will get real-time prices here. Now, for all currencies, you want euro, you want dollar, you want GBP, you want JPY, you want CNY, any currency pair that you can think of, all rates are provided here. Spot rates. In addition to spot rates, all import-export rates are also provided. If you go to a public platform, the that you get is only one rate, and you don't know whether it is the exporter's rate or the importer's rate. Okay, but here you get exporters and importers rates separately. You get importers rate and you get exporters rate separately, what we call as the bid and the ask. Okay, so that can be very easily fetched from here. In addition to this, if you want to take the forward contracts and you want to know the forward premiums for any currency, if you just tap on the home screen on the currency, it opens the calendar for the next 1 year. Okay, it opens the calendar for 365 days. And when you use the calendar for 365 days, you can pick and choose whatever maturity you want. Okay, it will give you the spot rate and the forward premium for that date. So it is not only spot rates, it is the forward rates for the next 1 year. Now, this is something which has created a lot of buzz in the market. A lot of people are using it. It has already won a lot of awards. In forex there is a very big problem. As I highlighted earlier, all of you are very busy people. You cannot take benefit of the volatility. Okay, the exchange rate moves by 20, 30, 40 paisa every day. How can I take the benefit of this rate? The exchange rate now is, let's take 74.80, but the exporter thinks that I want to convert at 75. But I have to keep looking at the rates to convert at 75. Not anymore. Okay, not anymore. What you can do using this app is you can put a rate alert. If the current market is 74.75 and you want to do the conversion at 75, you can keep a rate alert at 75 for that dollar conversion for any currency that you want. And this mobile application will notify you as soon as that rate comes. Okay, this mobile application will notify you as soon as the rate comes. So you need not keep staring at the screen or at the app. This app will notify you. It will also send you an email that your targeted price has reached. Now you can take your action. Okay, and you can put rate alert for any kind of transaction. You can do for cash, term, spot, forward, for any currency pair for the next 1 full year. Okay, so it does not only give you rates, it is also intelligent enough to work for you. And it is a system that will work for you. It will give you alerts. It will follow your commands for any currency pair, any alert for any maturity for the next 1 year. If you think about it, it is a huge benefit. It's a huge benefit. You can focus on your work. You can focus on your activities. Okay, this will take care of your forex part. We have been, as I said, living and breathing and drinking and eating forex throughout our lives. So we have a few traders who give forex trading calls. Okay, so just like you trade in equities, you can trade in currencies, and currency markets are globally, currency markets are far, far larger than equity markets. Okay, so whoever is a trader who wants to trade in the currency market, you get anything between 1 to 2 trading calls every day. So you can use these trading calls on your portfolio and make money. The application will show, we give trading calls on international markets and domestic markets also. So the application will show our performance, that whatever calls we have given in the last 1 year, how much money you would have made if you would have traded on our calls. So everything is very clear, everything is very transparent. You can evaluate our performance yourself on the app. If anyone is traveling abroad, he needs foreign currency, you can book a rate here. You can transfer money. If you book hard currency, cash or forex card, it will be delivered to your doorstep. Okay, nowadays we are delivering only till Delhi NCR, but very soon we are planning to reach out to pan-India audiences. You can book your forex rates here itself on the mobile application. You can register yourself, you can make the payment, and you will get the currency at your doorstep. We are a fully authorized RBI authorized money changer. You need a money changing license to do this, and we are a fully authorized RBI authorized money changer to do this. Okay, so that was regarding the app. You can keep typing your questions, and I very strongly recommend all of you to download this app. It is, as I said, free for use now. You can download it from Play Store and App Store as well, and you can use it for your purpose. It is free as of now. It is intelligent. It is smart. If you look at the research section, there is a lot of reading material in terms of what is happening in the market. In terms of, there are blogs, there are case studies. Case studies are real life problems that we have solved of exporters and importers, solutions that we have provided. So I'm sure you will gain a lot by downloading this app about forex markets, about currencies, about rates. Anything and everything under the sun about forex markets are covered in this app. Okay, it is available on the App Store and it is available on Play Store as well, for both Android as well as Apple users.
So we have few more questions, Mr. Victor.
Okay.
What is the difference between AD bank and authorized money changer?
Okay. Sir, AD bank is, AD is an authorized dealer, and AD bank is any commercial bank. Okay, SBI, ICICI, HDFC, any commercial bank is an AD bank. Authorized money changer is a guy who just converts currency. Remember, any AD bank is a full-fledged bank. They will be borrowing, they will be lending, they will be giving you limits, they will do money changing activity also. But a authorized money changer will only do money changing activity. They will not do banking facilities. Okay, so
Yeah.
understand, a bank is a full-fledged bank who will perform all banking activities, and a money changer is a RBI licensed money changer who will only provide money changing facilities, nothing else. Okay, so I think someone is asking, so a money changer is like, yes, absolutely, yes, Thomas Cook, Cox and Keynes, Myforexeye, all these are money changers. So for money changing, you need a license, you need an RBI license. But a bank is a full-fledged, AD bank is a full-fledged bank who does all the banking facilities, banking activities, borrowing, lending, funding, accepting deposits, everything. Okay. I hope, Mr. Narayan, that clarifies your question.
Yes. So we move to the last section of the program because now I can see the numbers are dwindling.
Okay. So I'll quickly see. I'll just answer Mr. Narayan's question also. PayPal, Western Union, money transfer, these are all money changers. They are authorized money changers. They are not banks. They are not authorized banks. They are not authorized dealer banks. PayPal, Western Union, Thomas Cook, all these are all authorized money changers. When I say AD banks, then it is SBI, HDFC, ICICI, IndusInd, PNB, Canara, all these usual banks. Okay. I hope, Mr. Narayan, your question is answered. Again, I will be you can reach out to me. There will be my email ID and mobile number. So if you want to really ask any more specific thing, you can certainly reach out to me. Okay. If I'm exporting through e-commerce, can I get my payment through PayPal? Sir, you can certainly get your payment through PayPal and Western Union, but why can't you use it? Why can't you use through a bank? Because PayPal, Western Union will have very high conversion costs. The cost will be anything between 2.5 to 3.5%. If you use a bank, it will be a more authorized and a more authenticated system, and the conversion charge will be relatively lower. Okay. I think, Mr. Push, I will just type out my mail ID here. If anyone wants to reach out to me on email,
Yeah, I will send the PPT. It must have your contact detail and everything. So let's quickly come to the last section.
yeah, sure.
Which is on the rupees, no?
Okay, yeah, rupee view. Okay, I think a couple of gentlemen in the chat box was asking what is the future of dollar in this month or in the next month. So again, ladies and gentlemen, sorry, understand what I'm trying to tell you in the next few slides is a view. Okay, till now, what I have told you was all facts and figures. They were all facts. It cannot be disputed. Everything was facts and figures. What I'm going to tell now is actually a view. It is backed by fact and figures, but it is a view. My view. I might be wrong. I might be right. Okay. So it is like forecasting the future. And I'm sure all of us understand that we are humans. We are not God to know what future is. But we can make an intelligent estimate using current fundamentals and current technicals as to where the currency is likely to go. Okay, so I will give you a few economic logic, a few economic ideas as to where we think the exchange rate is heading. Is it going to 72 or is it going to 78 in the next 1 year or so? You know, I have, whenever you analyze something for the future or whenever you analyze a financial market, uh, you do two kind of analysis. One is called a fundamental analysis. You analyze the fundamentals of the market. Okay. You analyze the fundamental factors of the market. The second analysis is what we call as technical analysis. You analyze the historical chart. I will come to each one of this in detail. So let me first come to the fundamental aspect. See, fundamentals are millions. Okay, there are millions of factors. There are a lot of known knowns. There are a lot of known unknowns. And obviously, there are a lot of unknown unknowns. What is going to happen in the future? Okay. Let us try and make an estimate of the known knowns. See, on the top left, I have written something called US rate hike. Okay. See, all of us understand that since March, April 2000, when COVID first struck, the US central bank had printed a lot of money. They were printing $120 billion every month. And they started from April 2020, and it is continuing. In their 14th, 15th, obviously it's a central bank, so they meet once in 6 weeks. On 14th, 15th of December, the US decided that they are going to reduce this free fund. Okay, they are reducing the free distribution of money. They were distributing this money to corporates, companies, and they were also distributing this to individuals because COVID had stuck. The companies were shut, people had lost their jobs. So it was a way of supporting the economy. But in December last year, the Fed very categorically indicated that this funding or this easy fresh printing of money is stopped. Okay, and since the inflation in US has gone so high, they are even looking at increasing the interest rate. So interest rates were low, were zero now, and they were printing more money. Now they are reducing the printing, and by end of March they will completely stop. They'll completely stop the printing of money. So the economy will have to run on its own. No more support from the government. And in addition to that, they will also increase the interest rate. So if they increase the interest rate, there is a huge risk of capital outflows from emerging markets like India. Okay, because so much of money was printed in the last 2 years or so, all of this money had gone to different markets of the world, including India. And that is one of the reasons why our stock prices had gone up so high. Now they are going to completely stop this support. completely stop this economic stimulus. So no more fresh money will come. In fact, there is a lot of risk that a lot of foreign currency outflows might happen. And if you see the center part of it, foreign inflows, what I have written, actually the outflows we have seen in the last two quarters has been quite substantial. Okay, in October to December last year in 21, we had seen an outflow of $4.6 billion, just 3 months. And in the current year, 22, in Jan and Feb, which is not even 1.5 months, we have already seen $5.4 billion of outflow. Okay, so ladies and gentlemen, be very clear. There has been a decent amount of $10 billion of outflow in about 5 to 5.5 months of time. And these outflows could accelerate because the US has stopped printing. Bank of England has stopped printing. They have withdrawn their stimulus. And since the inflation is increasing in these nations, the interest rates might go higher, and that will risk a lot of more outflows happening from countries like India. Okay, so I have highlighted 2 points which very categorically indicates that there is a big threat of rupee weakening. There's a threat of rupee going to 78. Now, another very important factor is what I have put on the bottom left. If you see crude prices, all of us have seen how the crude prices have gone higher. Brent is at around 91, 92, and it is consistently remaining above 90. It is not coming down. And the huge geopolitical risk surrounding Ukraine and Russia, that is only going to keep crude prices higher. Remember, Russia is a very big supplier of crude, a non-OPEC nation, and a very big supplier of crude. So if that confrontation, or if that geopolitical risk remains, crude prices will remain higher. And if crude prices remain higher, then you can understand where the currency will go. Rupee will weaken because we have to import a lot of crude. Our import bills will keep increasing. And if our import bills keep increasing, our deficits will keep widening. So that is another big risk why a reason or a big risk that rupee will weaken. Then there are factors of bond yields, then there are factors of dollar index. If you look at overall, except one factor, which is RBI intervention, what we have seen is RBI has been very actively intervening in the market in the last 3 to 4 months. They have prevented sharp rupee gain. They have prevented sharp rupee loss. We have seen because of their actions, RBI is relatively comfortable with the exchange rate at 74, 75. So this is a factor that probably RBI intervention could keep the exchange rate in control. But understand one thing, RBI will not be against a flood. They have limited resources. They do not have unlimited resource. Okay, and election time and LIC IPO time. So it is a very sensitive time for India, for exchange rate and for equity markets. So probably they would not want to take a risk during this time, leading to a large rupee weakening. But most of the fundamental factors that we see tend to indicate that there is a huge risk of rupee weakening. Rupee going to 76, 77, 78 rather than rupee going to 72, 73. Okay, so our fundamental analysis indicate that rupee will most likely weaken and go to higher levels. Dollar will go to higher levels. Dollar INR, which is 75, will probably go to 76, 77, 78. Okay, now let's look at the technical factors. Now, in this long-term chart, I do not want to invest too much of time in it because this becomes quite confusing and it is technical. People are not aware of it. It is in itself a very huge area of study. Okay, we do it very extensively. I am sure you being normal market participants, you might not be wanting to invest so much of time in it. But I will just give you a brief crux. See, if you look at this chart, the chart very easily indicates that it has been going on an uptrend. Okay, as exporters rightly feel that it goes on an uptrend, it is a continuous long-term uptrend. If you see the red line, I have connected the lows using the red line. So the red line is upward moving. Okay, it's an upward moving line. So the currency has usually gone higher. Also look at the blue line. The blue line is a very small technical indicator. And if you watch the blue line closely, in the last 11 years, the exchange rate has been below this blue line only for about 2.5 to 3 years. Okay, which means that the exchange rate remaining below this blue line is quite unlikely. It is more probable that the exchange rate will be above this blue line and certainly above the red line. So technically, there is a long-term dollar support at 72, 73. So very, very unlikely that the dollar will go below 72, 73. Very unlikely that it will go below 72, 73. Very unlikely that it will go higher. And if you see the trend is upside, the blue line, the red line, everything tends to indicate that the dollar will only go higher. Okay, so it is a kind of a recommendation to importers that if you see 73 level, 73.50 levels, or even close to 74, 73.50, 73.80, those levels are good to hedge for your imports. And remember, imports have forward premiums, so you should typically hedge for short periods. Exporters, since it is going higher, can keep the hedge ratios lower. Okay, so technically and fundamentally, if you analyze and if you invest your mind into it, your heart and soul into it, it looks like that the dollar is going higher only. Okay, the future for dollar, as one gentleman correctly pointed out, what is the future? The future looks higher. If you see the yellow line is some kind of a resistance, and currently that yellow line is somewhere around 77, 78. Okay, so I think our view is this year we will certainly see levels around at least 76, 77, if not more. Our actual view is rupee weakening more than that, but 76, 77, 78 is very, very likely for the next 6 to 9 months. So that is our view. After a lot of research, after a lot of analysis, this is the conclusion that we have on the dollar INR. Okay, so I can take the questions now, all questions. I would also want to just show this last slide because I want everyone to take my mail ID and the mobile number. Okay, so all of you can probably take a picture of this or just note it down whichever way you want. You can take down my mobile number and mail ID. And reach out to me, please. If you have any queries, you can ask me. I'm most happy to help. Okay, so now I'll come to the questions, and anyone who has more questions, please type it out. I will answer one by one.
Yeah,
okay. Who is authorized to raise ECB credit? Sir, any company can raise ECB debt. When you say ECB, I'm sure you mean external commercial borrowing, right? And not European Central Bank. Okay, so if it is external commercial borrowing, then any company can raise ECB debt. The only thing is you will need some kind of a credit assessment that will be done before the lender lends money in foreign currency. So that is a due diligence process that every lender does. And if the due diligence process is completed, fine, and a decent rating is given to you, you can take ECB. Can rating of local agencies be enough to raise ECB? Yes. Your existing banks with your rating of local agencies can give you ECB, depending upon the rating that you get. Okay, so I hope that question answers. Do you require EFC account at the time of forward booking? No, sir. EFC account you do not need at the time of forward booking. EFC account can be opened. Any exporter can open an EFC account. It can also be used to make import payments if you have imports. But having a EFC account is not mandatory at the time of forward booking. At the time of forward booking, a few things, just like your export history, your export documents, things like that will be required. EFC account is not a mandatory requirement. Okay. So I will ask. Okay. I will ask one more thing. When rupee weakening, with what? When rupee is weakening, what parameters whitening? Mr. Push, I couldn't understand this question.
Even I could not get Mr. Sangu M. Could you rephrase your question and post it again, because we are unable to decipher what you are trying to ask. We move to next question.
Next question. Okay. Mr. Raja Narayan has asked again. Can we take positions in FX derivatives without underlying exposure, such as export or import or foreign currency loans? That is for speculation. Sir, you can certainly take derivative positions on the exchange. If you are doing position, if you are taking derivative positions on the exchange, on NSE and BSE, you do not need any exposure. Okay. But if for, and you can easily do for speculation. But if you do want to do derivatives with the banks, then banks will discourage you. At some point of time, they will ask you for some kind of an underlying exposure. You might do for 5, 8, 10 million small amounts, but beyond a level, they will ask you questions. Okay, so if you want to do derivative trading for speculative purpose, then the exchange is the perfect platform for you. It is very good. It is very widely used. There are billions of trades that are happening. The rates are very fine and quote, and you will be able to access everything on your mobile application and on the website itself. And there are thousands of brokers who can do it for you. So FX derivatives without underlying exposure, best to be done on the exchange for speculative purpose. If you want to hedge risk for export import or for foreign currency loan, then use the bank. Okay, now Mr. Raja Narayan has sent an invitation. Okay, Mr. Narayan, I hope you have my email ID. I think let us connect on a separate level for this.
Yeah.
So I would love to go ahead on that. You can send me a mail. I can address you separately on it.
Absolutely.
Okay.
I think more or less we are through with all the questions.
I think Mr. Sangu M has asked. When rupee weakening versus what parameter is widening? Can we allow Mr. Sanju M to talk?
No, sir. I mean, listeners can't talk. Only panelists have that right to talk.
Only panelists have the right.
So he can also write you an email.
Yes. I would suggest, Mr. Sangu, please write my email. Okay, you have my number also. If you want to call me, you can call me at a convenient time. I will certainly speak to you. To be very honest, I am unable to get your question. I'm sorry, you have written 2-3 times. I'm still unable to get it. But you can reach out to me. You can certainly reach out to me on an email.
Right. Okay. So we have covered all the questions, I think.
Yeah.
One new message appears. Okay, noted. So
I think there is one more question. If an exporter has entered into a forward contract and receives forward premium, what happens if the currency appreciates? The premium compensates for currency appreciation. See, sir, as I said earlier also, if you do a forward contract, you get the forward premium. So you know what the premium you've got. You've got 4.5%. So if the currency appreciates, I mean, if the dollar appreciates, till 4.5%, you have no risk. The premium compensates for the currency appreciation. But if the currency appreciates more than 4.5%, then you might have a loss. Because, for example, I book a forward at 75 for 6 months, I get 76.50 as the forward rate. After that means 4.5% for 6 months. So after 6 months, if the currency goes to 77, which is more than 4.5%, then I lose. So the premium compensates for currency appreciation till that level, till the level of 4.5%, the premium that you have received.
Right. One more question has come from Rajan Naran.
Yes, yes.
There are instances when RBI intervene in the forex market to control the exchange rate volatility
By entering into swaps. Okay, I got it. By entering into swaps, it is said that such intervention will be liquidity neutral compared to intervention in the cash market. Can you explain how? Okay, good. I hope, okay, this is a different level of a question, but I'll still try and answer. See, sir, what RBI does is, obviously, when they intervene, understand they intervene by selling dollars and they intervene by buying dollars also. Okay, so when they are intervening by selling dollars, they are buying rupee. So when they are buying rupee, they suck in the liquidity. Okay, so to maintain that liquidity, rupee liquidity, they issue bonds. They do open market operations. Okay, so this is on when they are selling dollars and buying rupee. Now the reverse case also happens when rupee gains too much. Okay, when rupee gains too much, they buy dollars and sell rupee. So those are instances where by selling rupee, it is increasing liquidity. Okay, so sometimes RBI does certain tactics to be liquidity neutral, but at the same time, intervene in the cash market, intervene in the forex markets. And they also take positions in such a way that they increase systemic liquidity. Okay, so both happens, but it's a good question. I understand that when rupee is weakening and RBI is selling dollars, they are buying rupees, and when they are buying rupees, they are sucking the liquidity, and they infuse the liquidity by doing normal, usual open market operations by issuing bonds. Okay, and remember one thing, RBI is a phenomenal institution. They keep a very hawkeye kind of a watch on the money markets and all the forex markets, and all their interventions and all their actions are perfectly timed, and they time it and they control it in such a way that they time it and control it in such a way that there is no mishappening or unnecessary volatility even in the bond rates, in the money market rates, or in the FX rates. RBI intervene, but how does RBI intervene in the forex swap? You're talking about forex forward markets or the cash market? See, they intervene both on cash and the forwards as well. Okay, when you say swap market, what is that market? There's nothing called a swap market. Swap is an instrument. Mr. Narayan, swap market, there's nothing called a swap market. Swap is an instrument. It's either the forex buying now and selling at a future date is a forward market. So what earlier what RBI used to do is the interventions were mostly on the cash market. Now what they have done is, in addition to intervention in the cash market, they are doing interventions in the forward market. Okay, they buy now or sell now and take a countervailing position in the future. Okay, Mr. Narayan, you should certainly connect with me separately on an individual note, because I have to explain a lot of things which probably will go above the heads of a lot of people here, and it will end up taking a lot of time as well. But I will want to connect. Mr. Narayan, please take my mail ID. Please reach out to me. We should certainly connect. Okay. Now there's another question. If an exporter, I have received forward premiums and the contract maturity approaches, the currency appreciation is higher than, how do I further hedge my position? Okay. Sir, if you have taken a forward, you have received the premium, you approach the maturity and the currency appreciation is higher than the premium, then you have to, there are only two ways. Either you you cancel the forward, roll over the forward. If you take additional hedge, then you're taking a fresh hedge altogether. But the risk, that is the risk with forward. That is the risk with forward, that it's an obligatory contract, that if you once do the forward, you receive the forward premium, and if the currency weakens more than the forward premium, then you are at a risk. You get exposed to the market risk, because I have hedged at 76 and the market is now 77, so I end up selling at 76 when the market is at 77. If you want to eliminate that risk of currency appreciation being more than the forward received, you should do an option. If you do a vanilla option, even if the currency appreciates more than the strike price, you still get the currency appreciation. But for that vanilla option, you have to pay an option premium. So Mr. Dhara, you should also reach out to me and give me your mail ID. I will explain separately. That is a very nice risk management strategy that you can use, wherein you can use options to hedge risk. Okay, so options will help you at a time when currency appreciation is more than the premium that you have received. Otherwise, in normal times, when forward premiums are more than currency appreciation, the forwards will help. So you have to ideate and evolve to a system where you know when to use options and when to use forwards.
Absolutely. I think we have taken almost all the questions, except few those who want to really interact with you. They can do at their convenient time. And I must congratulate you for a very good session.
Thank you, sir. Thank you.
Deep diving into the intricacies of forex. And for one session, it is difficult also for many to understand. So, I mean, we require more time, and there are ways to connect, and maybe more such sessions can be organized in future with other sectors and industry. So this finally, these 2 days of workshop and training with the chemical allied sector and other listeners is coming to a conclusion today. Thank you everyone for joining. Thank you, Mr. Victor, and we will do such sessions in future. Please stay connected with TPCI. Thank you.
Sir, sure. Thank you, everyone. Thank you. It was really nice connecting and sharing ideas. I just hope you learned something new, learned a lot of things new, and I hope you think about it, introspect on it, and apply. I'm sure you are going to benefit out of it.
Absolutely, absolutely. Thank you. Goodbye
Thank you,
to all.
Pleasure is mine. Thank you, everyone. Ladies and gentlemen, have a great evening. Thank you, Mr. Push. You too. Enjoy. Have a great evening, sir.
Thank you. Thank you.
Thank you.
Bye.
Bye. Bye.
That's a great session.